Hello everyone, welcome to Indemi Student Channel. Maybe some of you have known me already from previous videos. I want to continue our lecture about a very common topic, which is the action should be taken when the market is falling down. Or we can also say when the price of the shares is in a low position. Investing into a stock is prohibited for those by panic, especially if the stock market is crashing and stock prices are falling rapidly. Stock is a high risk investment. Stock prices fluctuate very quickly, moving up and down like a roller coaster very quickly. However, that doesn't mean you shouldn't invest in stocks when the price drops. In fact, it is an opportunity to purchase shares at cheaper valuation. There is an analogy, there is heat and rain. Indonesia's economic conditions have not only experienced their best, but have also experienced very bad times. This is also useful for the capital market. The decline in the capital market occurred in 1998 and 2008. In 1998, there was a financial crisis with inflation reaching 58%. IHSG, or named as Indonesia Stock Exchange, plunged to level of 398. Similar conditions repeated 10 years later. In 2008, there was a crisis triggered by the subprime mortgage scandal in the United States, which caused a sudden collapse of capital market around the world. 12 years later, in 2020, the spread of the coronavirus can be regulated globally and has a negative impact on the stock market in Indonesia. Many investors choose to escape their capital in safe haven assets such as gold and debt securities and are slowly starting to turn over their investment ownership in the Indonesia Stock Exchange. Before I discuss the tips of facing drop share price, we need to know the characteristics of stock market. Stock prices are very volatile. Volatility is a measure of the level of fluctuation in the price of a security from time to time. It shows the level of risk associated with changes in a security's price. Investors calculate the volatility of stock prices to assess past price variations in order to predict their future movements. Governments play a major role in regulating industry and can influence economies when they make decisions about trade agreements, laws, and policies. Everything from speeches to elections can get a backlash among investors, affecting stock prices. Economic data also plays a role because when the economy is doing well, investors tend to react positively. Monthly jobs reports, inflation data, consumer spendings figures, and quarterly GDP calculations can all influence market performance. Conversely, if this misses market expectations, the market may become more volatile. Specific events can cause volatility in an industry or sector. In the oil sector events, major weather events in important oil producing regions can cause oil prices to rise. As a result, the share price of companies that are related to oil distribution can go up, which is expected to be profitable, while companies that have high oil costs can go down. Likewise, more government regulations in certain industry can result in a fall in the share prices as increased employee costs and costs can affect future revenue growth. Volatility doesn't always apply in all markets and can relate to individual companies. Positive news such as strong earnings report or a new product that wows customers can make investors feel good about the business. If many investors want to buy it, this increase in demand can help drive prices up sharply. In fact, product recall, data errors, or bad behavior can damage the stock price as investors sell their shares. Depending on the size of the company, this positive or negative performance can also have an impact on the wider market. Stock prices change frequently throughout the course of a trading sessions as investors observe various events in the stock market. It may seem surprising that one piece of information or a single event can fixate investors in the equity markets where thousands of companies list their shares, but it happens every day. Much of the stock market's performance is tied to investor expectations. Whether or not those expectations are met influences whether the stock market shows gains or losses. A bull market is a market that is on the rise and where the conditions of the economy are generally favorable. A bear market exists in an economy that is receding and where most stocks are declining in value. Because the financial markets are greatly influenced by investors' attitudes. These terms also denote how investors feel about the market and the ensuing economic trends. A bull market is typified by a sustained increase in prices. In the case of equity market, a bull market denotes a rise in the prices of company shares. In such times, investors often have faith that the uptrend will continue over the long term. In this scenario, the country's economy is typically strong and employment levels are high. By contrast, a bear market is one that is in decline. A market is usually not considered a true bear market unless it has fallen 20% or more from recent highs. In a bear market, share prices are continuously dropping. This results in a downward trend that investors believe will continue. This belief, in turn, the downward spiral. During a bear market, the economy slows down and unemployment rises as companies begin laying off workers. First tip during stock prices is to observe price movement. Share prices don't always fall even though economic conditions are difficult. Over time, the stock will reverse direction, strengthen at a higher price. What causes it? An increase in demand from investors or the public for a stock when the price goes down, so that the price slowly returns to previous position. Before buying company stock, investors need to observe the proportion of price increases and decreases in the last 3 days. The decline in share prices could bring blessings to investors, although maybe some other investors think it is a disaster. You can buy targeted stocks with a quiet lots at cheap prices. If normally in the table with 900,000 rupiah, you can only buy 300 of A shares. When the price drops to 2,000 per share, you can buy 450 shares. If investors just take the opportunity without thinking, they will buy a lot. But you have to have a strategy. We recommend you To avoid buying directly in large quantities, buy stocks gradually because it is possible that the share price will decline again in the next day, so you can be more profitable. Purchasing shares can also provide you with opportunities to open up stock price movements in other sectors. So, you don't pull all of your money in one sector. This method is called diversification, which can help minimize investment losses. Do not buy stocks just because the price is cheap. You also have to be observant and careful in choosing the stocks to be purchased. Select stocks that are related to easily rebound or strengthen again after the price drops. What kind of stock? Usually shares of companies that have a stable financial condition. So, in addition to looking for stocks that are cheap, also do fundamental analysis such as financial reports. When you dive into investing in stocks, you must be prepared for all of the risks, including price reductions, even with novice investors. Don't be panicked immediately if the stock price drops, especially if it drops sharply. Immediately thinks the investment is losing, confused, and finally decides to end your life. Just so you know, the decline in share prices must have an end. Will go back up or rebound from red to green. So avoid panicking and try to purchase more shares as the price valuation is lower. Panic will lead you to mistakes in making decisions, such as taking a big sell off. Investment is the same as monthly spending. You must have a budget plan to keep it under control. Do not because the stock price is dropping again, you will end up buying up stocks without thinking, especially when it comes to debt for investment capital. You need to do an evaluation. Is the investment budget still enough to buy a few lots of targeted stocks or not? If that's not enough, put off the purchase. Just focus on the stocks that you already collect. It is not good to be forced. Who knows? When you have another investment budget, you can buy stocks at a discount and the market conditions will stabilize. Immediately, separate your income for very important expense items such as bills and debts repayments and other expenses. If after the monthly budget is evaluated and there is a nominal amount of money left over, do not immediately spend in odd extravagance. It is better to save it for unexpected needs. Everyone needs a reason to invest when you set up an investment. The biggest long term financial goal for most people is saving enough money to retire. But to make sure you are really saving enough and you not to figure out how much you will actually need to retire and to what you will allocate it your money for. Owning your home should be a high priority and one to achieve if possible in the first half of life. Entering retirement without being a homeowner is risky as it puts you at the mercy of rising rents at a time when your own income is restricted. In addition, a home itself is an investment, usually increasing in value over time, and in retirement, you can draw upon this value without selling your home by using equity release. Funding education can be one of the biggest costs. Even state education comes with a lot of expenses, from uniforms and sports kit to school trips. Fortunately, you can predict exactly when the costs will hit, since you know a child will start primary school at or near the age of 5, secondary school at age 11, and higher education at 18 or 19. You can therefore time your investments accordingly. This is the big one. Your retirement may last half as long as your whole career, so you need to think about what you will do for income. It is never too early to start investing for retirement. In fact, the early the better, as compound interest over time is your most powerful asset here. Okay, to review this lecture, I want to give you some questions. Feel free to pause the video and try to answer these questions. So, thank you for watching this video. If you like this video, just to make sure to press like button. Please leave comment if you have further questions and don't forget to subscribe.